The Bank of England has taken urgent action to avoid a meltdown in the UK markets, unleashing a £65 billion bond buying programme, after they identified a material risk to the UK's financial stability, from all the turmoil in the gilt market which was sparked from the Chancellor's tax cuts and their borrowing plans. This is pretty drastic action that nobody expected, but what does this actually mean to a normal person? First off, a bond is a debt-based investment, which is essentially an IOU for a set amount of years which pays a return. Gilts are just a fancy name for government bonds, so they're all bonds. They're created by the government when they want to generate money. I wish I could just print money. And I'm thinking about covering how they all work in more detail in a further video. If you'd like to see that, drop a like below to let me know. So first off, the Chancellor announced a pretty drastic £45 billion package of tax cuts, which has been extremely unpopular, especially cutting the 45% higher tax bracket. A lot of people thought that wasn't needed, which has got most people saying the Chancellor is done for, and we need to call for a general election ASAP. But politics aside, 45 billion is really not great, when inflation is already so high. The Bank of England was expected to raise interest rates even higher than expected to counter inflation, but instead they announced they're committing to buy £65 billion in bonds, in order to try and restore the UK market. Now that sounds like it's all nonsense, which it may well be, but there's a reason they've done this. Pensions and insurance companies, which manage trillions in people's cash, rely heavily on these bonds for their hedging activity, which makes it very expensive for them. And by hedging, I mean their investment portfolio has some equities, but a large portion of them are bonds. And this is just to balance the portfolio if the market moves one way or another. Pension funds invest in these particular type of government bonds because they're usually seen as a safe investment. Because to buy them, pension funds have often borrowed money from big banks. But as of the budget, the markets have lost faith in the UK as a safe investment, so the value has plummeted. Now the banks have turned around to the pension companies and said, in these uncertain times, we're going to need some cash as collateral, which is called a margin call. Essentially, so they've got money to cover potential losses if they continue to fall. But to raise this cash, the pension companies have had to sell bonds, which has had prices down even further. It's caused prices to spiral downwards in what some are calling a doom loop. It's been so bad that the markets effectively stopped working, and there were fears that some of the large UK financial institutions would go bust. So the Bank of England has pretty much been forced to do this in order to try and restore confidence in the market. From their past experience in the financial crisis, the Bank of England have learned they have to go in hard and fast, and not waste time, which seems to be what they're doing. They desperately have to try and fix the situation to stop the downward spiral of the UK economy. A nightmare situation that's not good at all, but the cause is actually the budget, and the latest Bank of England stunt is what they've almost been forced to do. There will likely be more interest rate hikes to come, which will make mortgages more expensive, which is really what I feel is a scary part that no one talks about. Stopping the rise in energy prices sounds good in theory, but if that saves me £250 per month on the gas bills, and my mortgage is now £500 per month more expensive because of rate hikes to counter it, it really doesn't sound too good. I'm going to try and share lots of ideas on making some extra cash to help people through this tough time, and if you need any advice or support, just drop a comment down below as I read and I'll reply to everyone. Thanks.